Well, hello, and great to see you all on another Tuesday evening, just in pre-show mode for a few moments, just having a little chuckle to myself that I think in the World Cup, England is playing Wales today. So it's quite funny, really. And they're both, could do better. Anyway, we'll see. Doggies are here. They've been sound asleep. I took them for a long walk, or 4 long walks actually today. And they're flat out now, having a little dream about chasing rabbits possibly. So I don't think we're going to get much squeak out of them tonight. But, they certainly always look relaxed, don't they? And some interesting questions already coming in. We might talk about the RBA and what they've been up to. What Mr. Lowe said yesterday. Interesting questions about China and what they're doing and where that goes from here on. And some of the implications there I think are quite significant, so that'll be worth exploring. And of course, the big question, which is everybody's trying to work out now, is, well, the market's turned, are we going up, or are we going to see another leg down? And there's actually a question by way of a poll. So if you get a chance over the next hour or so, go into the poll and make your vote, and I'll put that up later in the show. Anyway, Cookie Boy says, are the dogs alive? Yep, I can confirm. The dogs are definitely alive. In fact, sometimes I think they're a bit too alive, particularly when anybody comes up the drive. I don't need a doorbell now because by the time the dogs have been barking, the time people come up the drive, I already know that somebody's here. So it's quite funny, really. Okay. Right, well, enough. I think we're just starting to hit into 8:01, so I'm going to take the pre-show off. I'm going to run the introduction. I'll be back in just a moment. Well, good evening and welcome to this live stream on the 29th of November 2022. Martin North from Digital Finance Analytics here. Great to have you all on board. We're going to have an interesting conversation this evening about the financial markets and investing and what's going on and whether we're going to see the markets turn or whether they're going to continue up, down, sideways or whatever, what's happening with inflation. And there was a few other questions that came in earlier on, which we'll also touch on as well. Before I bring Damien in, he's just making some final adjustments, I see. I'm just going to remind you, of course, as I always do, that we don't provide specific financial or legal advice on the channel. It's a general conversation only. The chat room is moderated, but I do encourage you to share your thoughts and opinions. This is as of 29th of November 2022, if you're watching in replay. If you'd like to ask a question, I do encourage you to do that. Use that Walk the World to get my attention. And I can then bring the question to the top of the list. And if you want to make your question right at the top of the list, you can always use Super Chat because I've enabled Super Chat, and that also enables you to make a contribution to what we do here. Always appreciate it. I don't necessarily acknowledge every single Super Chat that comes in because it gets a bit busy, but they are all greatly appreciated. Anyhow, without more preamble from me, I'm going to push this button here and bring Damien in. Damien, hello.
Martin, good to see you again.
Yeah, I know. Another month flies by. Can you believe it? We're close to the end of the year. In fact, this is your last show this year with us because the next one will be the first show in January next year.
Yes, that's right. So yes, happy holidays to anyone who it's and thanks for a good year, Martin. It has been a very, very interesting year. Very different to the prior year. Yes.
Yeah, the old proverb about living in interesting times, right? I think this year has been a really, really interesting one. I mean, I made a call at the sort of turn of the year, and I said I think it's going to be a down year, so I sort of went towards cash. And actually, frankly, although the market's starting down a bit, I actually done not too badly by doing that because basically I insulated myself from some of the downside. Obviously, the inflation has eroded the real value of those savings, but relative to the capital losses that I think I would have probably taken, I think I've probably done the right thing. But it's a really interesting question now, right? Because the markets are sort of going, oh, it might be up slightly. In fact, show you this is the ASX 200, all right? And so it's sort of knocking around 7,249, and if you look at it where it was back in November last year, it's quite a lot lower. So in fact, a lot of the lost ground has been returned, particularly in Australia, even in some of the other markets too, less so. So what's your take? Is this, a blip up before it goes down again, or have we hit the bottom? What do you think?
Yeah, for me, it all comes down to earnings now. So what we've seen is earnings have just started to turn down, very much at the margin so far, and now the question comes is that will we continue to see earnings fade off? All of the forward indicators are suggesting they will. So everything that you look at in terms of surveys and various sort of measures that look at inventories and forward orders and things like that, all suggest that earnings will fall sort of somewhere between 5 and 10% at least, and with the potential that they could go further. So with that in mind, I guess the thing for me is saying, well, I think this rally's been another chance to sort of reset yourself a little bit and to take a little bit more off the top. Where could we go wrong? Well, the froth has come out of the market in terms of the overvaluation. So we're expensive at the moment, but we're not sort of at the nosebleed expensive levels that we were at the start of the year. And if I'm wrong on the earnings side, and the earnings are much hold up much stronger in front of the the rate rises and all that type of stuff, then we could see maybe stocks have bottomed. I don't think so, but you'd have to have a pretty good you have to have a very positive view on earnings, I think, from this point on, because that's where the strength and the weakness is going to show up.
Right, and presumably that really does come back to the consumer land, doesn't it? Because certainly in Australia and in the US, what the consumer does or doesn't do is going to be a very significant lever in terms of a lot of firms and therefore a lot of earnings.
Yeah, absolutely. And, we've spoken a lot about those interest rate rises. I think we saw there was during the week, Chris Joy had highlighted one of the charts, one of the bits of data the RBA had put together, suggesting that if, based on where rates are sort of forecast to go at the moment and where we've pushed them already, that sort of 15% of borrowers would have negative spare cash. Let alone the ones sort of who are sort of struggling. 15% of people have to sell their house. That is a massive blow to the housing market. Usually, it swings on very small percentages of people having to sell their houses is enough usually to see house prices fall quite considerably. And we've already seen house prices fall quite considerably without even that extra push. So, I think there's you can put together some positive scenarios if a whole bunch of things go right, but there seems to be some pretty significant downside if they don't go right.
Yeah, and just on that, it's worth just looking at the consumer confidence index. This is from last week, right? And it really is in the gutter, which is interesting because the ANZ just put out their Black Friday sales numbers. And from their sort of fast data, it looks as though consumers were actually spending quite a lot, although some categories much less so than last time around. And particularly electronics goods was one in particular that came away much lower than last time. So I'm interested to see how that comes through. And you're right, the joy chart was very significant in terms of showing that there are a number of people who are getting in difficulty. And in fact, Roy Morgan put their stress data out this last week as well. And they're now saying that on their numbers, 22.6% are in some degree of difficulty, and 14.4% of those are actually in extreme risk. Now, they define stress differently to the way I define it. So I look in cash flow terms. They're looking at it more in terms of what the underwriting criteria would be within the banks. So it's a lower number than mine, because mine's 1.4 to 1.5 million, but they've got 1 million households now. So that's another negative indicator that I think is quite significant.
Yeah, and it's there's some interesting thoughts. I mean, we obviously saw some weak numbers in weak retail sales numbers, the latest ones that came out, which was for October. So that actually went backwards. I can't remember the exact number. It was a very slight decline. But if you take out the inflation effect, then it was actually quite a large decline. Having said that, yeah, I have seen a number of indicators that are suggesting that actually November hasn't been as bad, and that, as I said, that those Black Friday sales data and some of the other credit card data that I've seen, and I guess there's this argument, I guess a question mark, I suppose, over a lot of this for people in terms of saying, look, is this it's a big problem sort of looming, and maybe for a lot of people that just means I'll worry about it next year. It's yes, there's a significant amount of people with mortgage resets. There's a significant amount of people still seeing those rate rises come through, and it's pretty close to the end of the year. There might. I guess what I'm saying is I wouldn't be terribly surprised if retail sales hold up all right over this Christmas period. I wouldn't be shocked if they fell either. But I think I'd be surprised if we're not seeing some quite significant falls into the new year. I think those first couple of months of the new year we really will start to see that pressure start to hit. Yeah,
and it's interesting that credit card debt is just moving up now, having for the last year, 2, 3 gone. Now it's gone up a bit, and there's quite a strong correlation, in fact, between those who've got financial pressures and using more credit cards. I see that in my surveys. The other thing I've done in my surveys this last time is to ask households about whether they've had to dial back their eating. So are they eating less meals, smaller meals? And it's quite interesting because over the last 2 or 3 months, I've started to see a bit of a trend emerging. We are starting to see more households choosing to change their meals, eat less, certainly don't eat out but eat in, all of those things seem to be there as well. So that's another indicator in my data that suggests that ahead things are going to get more tricky. And of course, remember that the interest rate rises don't hit immediately. It takes 2 to 3 months for those to flow through on variable rate loans.
Well, and 2 to 3 months for just the very first part to occur.
Yep.
Then the actual effects take up to 12 months. Yeah.
Yep. And in fact, some of the research suggests that it could be up to 18 months before you see the full impact of those rate rises really hit. So one reason perhaps the RBA is more right than wrong to say let's go slow rather than too fast. But of course New Zealand, 75 basis points, ping, cash rate.
Yeah, it's one thing to say let's go slow, not so fast, and it's another thing to say after you've just raised rates faster than they have ever done in the history of their entire.
Absolutely, yeah.
So
I guess it's worth just reflecting on the RBA briefly because, of course, I'm certainly sorry if people listened to what we said and then acted on that and now regret what they've done. He said yesterday in Senate estimates. First time I think he's been in front of Senate estimates, which is a sort of a weird sorry but not really sorry.
Yeah, that's right. That sounds a bit like the sorry if you've been offended, Martin. That's,
yeah, that's right. It's the Morrison school of saying I'm sorry, right?
Yes, that's right. Yeah, well, it's. I mean, I don't know whether there's what the legal issues are. I'm not a lawyer, and so I suspect there's a little bit of this type of thing they need to be a bit circumspect about. But yeah, it's. I think there's one thing to I guess from my perspective, it's one thing to change your mind, but it's another thing for the RBA. There's that comment, but the other thing on top of it was from a trader's perspective is they basically saw that the markets changed the RBA's mind for them. So the RBA promised they're going to keep these rates low, and then the market started trying to push them up, and the RBA basically capitulated. Yep. And so I think on a few fronts they've lost a bit of credibility. And I don't mind if they wanted to capitulate after, but actually say, okay, now we're doing this on purpose. We're not doing it because markets made us. We're drawing a line in the land, stopping markets at this point, and then we're saying, okay, now we're actually going to let it go because we want to, not because we're making these suggestions. And
well, just remember, yield curve control was basically busted because the markets But
yeah, absolutely. And I feel as if he could make that same apology to anyone looking for yield curve control.
Absolutely.
I'm sorry if you listen to me. I'm just a lowly central banker.
Sort of begs the question then. Is the central bank here really on song or not? And I guess around the world, if you look at New Zealand, Adrian Orr in New Zealand has been very clear, particularly over the last 3 or 4 months, and saying inflation has to be crushed. We've got no choice. That means we've got to put rates up. People are going to get hurt. House prices are going to fall. There will be some businesses damaged, but we've got to do it. And if you look at what the Fed has been saying, more recently, they are still saying we've got to put rates higher. It might go up slightly slower, but we've still got to put rates higher because we're not. And in the UK, of course, where they've already got a recession, again, another big rise there. So it almost feels as though the RBA is sort of somewhere different from pretty much every other central bank. Now, the question is there something unique and different about Australia? Maybe it's just the amount of debt we've got. Maybe that's the reason.
The uniqueness for Australia is, there's two things. One is the amount of debt. I mean, we're right up there, but we're not. I guess there's other countries with similar-ish levels of debt. But we are very high. The other one is the amount of variable mortgages. Most other countries, well over 50% are in fixed rate mortgages, and some are 90 or more percent are in fixed rate and quite long dated ones. And so they should affect the Australian market more quickly. I guess so. I guess I'll come back to what I was saying before. I mean, it's really the messaging that's a bit weird and sort of inconsistent in Australia, because the rate rises have been pretty similar in terms of what we've seen overseas. And I guess, I probably commented on that before, that, I guess we spoke about the Fed's been doing 75 basis points every time they meet, but they only meet every 6 weeks. Yep. Whereas the RBA has been meeting effectively every 4 weeks and doing 50 basis points, which is exactly the same speed of rate rises. And so, I guess that's been my complaint, is that we're speeding away, and we've got a higher debt burden, and we know it's going to flow through so much more quickly. And I'd like to see the effect of it a bit more. And so, we spoke about, as you said, the 12 to 18 months. We really haven't seen much of the effect of even the first rate rises that came through. So, I guess my personal thing is to be a little bit more circumspect, but I agree that I don't think central banks are. I think central banks have, and there's a number of sort of people who were previously quite dovish. We're talking about lower interest rates, who have now completely flipped and are saying no, and are on the path of saying you have to worry about 1970s style inflation, and it's like a bit like the the zombie that keeps coming back. You got to crush it and really make sure that it's dead. There's no sort of oh, look, inflation looks like it's falling, maybe we should lighten up. There's a number of central bankers who are really talking about crushing it, which basically means having a big recession until they're absolutely certain that the inflation is down. The other interesting sort of circular one that you get is there's a lot more talk now about financial conditions and how that affects interest rates and what that means. And so and the Fed in particular pays a fair bit of attention to financial conditions. And one of the measures and why they look at that more now is because there's this recognition that as we've been blowing all these asset bubbles, there's this wealth effect that comes from blowing these asset bubbles. And when you do so, it positively affects inflation on the way up and negatively affects inflation on the way down. And so it's almost a dichotomy we've got, in that if markets rally because they think the Fed might be slowing up or cutting rates, then that's actually a signal that the Fed should be raising rates even more, because financial conditions are getting easier. And that, it then gives the Fed more ammunition to actually raise rates even further. And there's sort of discussion about, well, the rally over the last few months has sort of been enough to to sort of wipe out one of the rate rises in terms of the financial conditions index. And so does that mean they need to go one further? And so, that's sort of one more reason why I think that, we're at the point where if the markets keep rallying, the Fed's just going to keep raising rates. So it's a little bit catch-22.
Well, they keep saying, we've got to get demand under control because it's a supply-demand disequilibrium. Although actually, it's really interesting. A lot of the narrative from the central banks really doesn't really recognise the fact that they caused the problem. Although actually yesterday, interestingly, in the Senate conversation, Phil Lowe did concede that the ultra-low interest rates and all of their flooding the banks with money and, that was part of the inflation. So he did actually recognise that was part of the inflationary drivers. So in other words, he and other central bankers were responsible for creating some of this. Of course, they prefer to use the Ukraine narrative and the supply chain disruption narrative, nothing to do with us. And that all is part of the story. But actually, at its heart, the supply disequilibrium has been created by printing way too much money, taking interest rates way too low, and throwing huge amounts of liquidity in. Now, Phil Lowe has said consistently, at the time, we were really scared about what was likely to happen, 15% unemployment, and therefore we threw everything we had at it. My problem with that narrative is it started to become clear quite early that, in fact, it wasn't going to be as bad, and yet they still went on. So there was probably a year to 18 months where I think they could have started to turn the dials back and not create such a big problem, but maybe I'm just being a little bit post the event.
Yeah, I guess I look upon it's an extremely important question about how much of this is supply side driven and how much is demand, and how much of it is because we actually had a lot of direct cash flashes from not just the Australian government, but plenty of other ones. You did lots of direct cash inputs into their economies, and the US was sending out checks. Then you have some other countries like, I guess China's a bit hard to completely compare with this because they have obviously still been going through sort of some lockdowns and issues like that. But China has went down very much the path of trying to subsidize companies and give them more debt and tax breaks and all that type of stuff, and really not giving much at all to consumers. And they have also been seeing very low rates of inflation and weak demand. Now disentangling zero COVID from stimulus and all that is very difficult. But I guess Japan's another area where, particularly if you cut out the spending that's happened there in terms of, or you cut out the energy costs because Japan's a huge energy importer, then inflation there is below 2%. So I guess I'm still leaning on the path of saying, well, if you're saying 70% of this is the supply side and 30% is demand side, then we could get a really sharp snapback later on next year. If it's the other way around, then maybe then you're probably right, and inflation probably won't fall as far. But it's probably worth jumping to some of these charts, I guess, on that just to sort of frame this for people.
Sure. Share your screen.
So I've got it. I've got. I think I'm sharing. Am I?
No,
I'm not. Let me do a new share and try again.
Yep, it's coming on. There you go.
Got it.
Yep.
Okay. Okay. Sorry, I should go back to this one. So, so what I've got here is actually, sorry, I've jumped forward too far. Let me get back. 4, 3, 2, 1. There we go. Okay, so this is the food. This is food inflation in the US, and the first sort of line that you've got. I guess I'll explain the categories. I know it's probably pretty small on the screen, but let me explain the colours, I guess, which will probably put into a bit more into focus. Is on the first sort of column that you can see of reds, that's the inflation that we saw up until December 2019 on a 10-year basis, a 5-year basis, and a 3-year basis. Then we've got, and keep in mind, this is all food for this one. Then we've got up until October 2022, over 3 years, 12 months, 6 months, and 3 months. And then finally, the last 3 columns is the most recent months that we've seen. And so on this one, it's pretty clear. You can see that deflation or very low inflation for most of food, particularly food at home, which was basically had either no inflation or very, very low inflation for the that 10-year period. Then we've got this huge green part where it just took off over the period to October 2022, and then we've got the most recent months where it's starting to slow up. It's not particularly slow, but it's starting to get there. Probably more importantly, if you look at the one right at the bottom, which is the restaurant food away from home, and that's probably one of the bigger categories, that's actually really strong, and actually inflation there is getting worse, not better still. So so not a lot of good signs in food. The same graph, but for energy. Now, energy is a bit all over the place. So you've had deflation for years in that, but actually the last 3 years to 2019 was pretty positive, and then you've had this roaring inflation in energy for some of it, and then the last couple of months these big negatives, and then there was a big decent sized rise in October, and we've probably got a bit of a fall coming for the next one. So that's a little bit all over the place, and really depends upon where your starting point is. The most interesting ones is when you start splitting it into goods versus inflation. Now, goods was a solid source of deflation. Over the 10 years, you basically had negative 0.3 inflation. So, deflation in goods prices. You can see a lot of that green in the middle column, but there's a few specks of red, and certainly that last sort of over 3 months to October, there's a number of sort of chunks of red. And in when you start breaking it month by month, October itself, there's starting to get some pretty negative points on the goods side, and we're back to deflation. Goods were down sort of 0.4% in October. So very much that what we've been talking about, saying a supply chain, the supply chain problems are now going away. They're starting to people are starting to switch back from goods into buying services as they're able to travel more, and that means that we're starting to see that deflation into goods. And then finally, the services side, where the 5 and 10 years up until 2019 were pretty strong. Like you saw, services were growing at sort of 3%, almost 3% inflation for most of that time period, with a couple of exceptions. Things like telephones and internet had deflation, but most of the services sector was seeing inflation. Some pretty good inflation through to October and getting stronger, and not I think if you were extremely optimistic, you could see some positive signs in it. It's probably really it's a glass. The glass is halfway. It's I think you could probably call it half full or half empty, depending upon if your approach. But there's still some reasonable signs of inflation, but a few pockets where maybe there's things might be starting to ease. But I guess that's that narrative we've been speaking about in the last few months about the handover from goods to services is still very much in swing, and we are starting to see that deflation starting to come through into the goods sectors, but not yet leak into the services.
And just work on that, of course, services is going to be much more directly correlated to wages growth, isn't it? Because that's
absolutely
predominantly people.
Yeah. And the other thing as well is worth, I didn't show the chart. I've got a chart as well that I should have thrown up, which is basically just showing as well that if you have if you thought financial conditions right now were perfect, like interest rates were exactly right, and we were going to start cycling, a little bit less than 0.2% per annum, per month, every month from here on in, so that you end up with 2% inflation. Then because of the way inflation's been rising in recent months and how it's put this, this recent spurt on, it's going to be March or April before you actually get inflation. Well, come March, you're still talking about 5% inflation. You're going to be talking about as a headline number. So it's not coming down quickly. It's going to be and even I guess when I say it's not coming down quickly, even if inflation went to deflation tomorrow, like from November onwards, everything's back into deflation, you're still going to be at 2% annualized inflation, come March, because of the inflation we've already seen this year. And so, there's always this question about, well, should you be measuring it over 12 months, or is it 3 months, or is it 6 months? And there's going to be lots of arguments, but the way I look at it is it's going to be very hard for the Fed to do anything if the annual figures are still really high. Even if they're looking at the last 3 or 4 months and saying, wow, it looks like we've got deflation, we've done too much, they might take their foot off the accelerator, but it's very hard to see them, actually reversing if you've got annual inflation still at, 4 and 5%. Yeah.
So, on that, we're talking about the base effect, right? So basically,
yes.
If there were strong rises a few months ago, they stay in the number for 12 months and then drop out, right?
Yes. Yeah, that's right. I'll see if I can I felt like I did have this chart. Let me see if I can bring it up quickly for you. I'm sure I can.
That's all right. So you fish around that. So the point about base effects is it's all in the numbers, right? So the numbers wobble around, but essentially if there were big numbers in the last few months, they'll be around and then they'll suddenly disappear.
Can you have I got that inflation one showing now?
There you go.
I'll put up a bit more. So this is basically saying if you said today's settings we're going to generate 2% inflation, that's the orange line in the middle, then by March you headline and core, both headline and core inflation are 4.5%.
Yep.
If you said we're actually into deflation already, by March, I think you'd have 2.5% maybe for core and headline inflation. So you're still above the target. So, even though you might have had whatever it is, 5 months of deflation, the Fed would still have to turn around and say, yeah, well, inflation is above our target, but we're going to start cutting rates. And I just find that very unlikely. So I guess it sort of leads to that. We keep speaking about policy error. There seems like a reasonable chance we're headed for policy error. The other one I wanted to talk about, while we're talking about these rising interest rates and issues in Australia, is we've had a couple of guests on recently just talking on our podcast, the Nucleus podcast, just talking about bankruptcies. Yep. And there's a couple of the interesting ones that what we're hearing is the tax office is back. So basically they disappeared for a couple of years where they were basically told, when people aren't paying their tax, we're not going to take them to court. We're not going to shut them down. We're not going to, put in the wind-up notices. But that's changed. And now they're actually, very active in terms of chasing up a lot of these debts. We've seen, so in Australia, we saw, quite markedly lower levels of bankruptcies. Now that might be because people generally don't take other companies to court, and I guess to put that into context, let's say you've got let's say you're supplying something and somebody owes you 50 grand because they haven't been paying your bills, and maybe they owe a bunch of other people 50 grand as well. Is that for each one of you, if you want to take them to court, it's going to cost you 20 grand at least, and if you don't know if you're going to get that money back, I mean, if everything goes well, then you'll get your 50 grand back, and then you'll get your 20 grand you spent on legal costs, or 30 grand you spent on legal costs and everything. And, happy days, you've got your money and off you can go. But if that company's broke, then you're just throwing good money after bad. And so often what happens is for $50,000, $100,000, $200,000, companies will just, give up on it and say, well, they won't do it. And so the tax office tended to act as a little bit of a a public policy, a public good there, where they would chase people up for those debts, and they would follow through and liquidate companies. And so we've been through this big period where they haven't, but now that they've started again, what the question is, what are the flow-on effects of that? So we've sort of got a number of these. They've got these lagged interest rate rises coming through. We've got more more people with fixed loans than we've ever had before, and so that's sort of another sort of impending doom that sort of as people are rolling off their 2% mortgages and onto these much higher mortgages. And then we've got the tax office finally back and starting to clamp down on these. All of these put together sort of point to some. You know, you don't want to say it's definitely going to happen, but there's certainly a lot of warning signs now at the moment that are well worth heeding.
Yeah, and just on that, I was talking to somebody who's in the insolvency industry, and he was saying that it was very quiet, of course, through COVID, but then it's been really, really busy. But nearly 40% of all the insolvencies that he's dealing with at the moment are in the construction and similar sector, right?
Yes.
A massive amount, firstly. And secondly, most of the problems that actually he's dealing with are the outfall from COVID. So this is not yet due to the rate rises. This is actually the prior period that created the problem, partly because people were given a lot of elastic to continue to trade insolvent and those sorts of things. And now suddenly the dials have been turned back up and normal rules of business apply. And so people who actually got quite a lot of runway suddenly discover the runway got nicked. And final point is quite a lot of these people actually have their residential property secured against the business. And what that means is that a lot of the for sale foreclosure properties that are currently there are actually where a business has gone bad rather than just a normal mortgage debt, because the wave of defaults from higher interest rates have yet to hit.
Yeah, that's interesting. That's interesting because, yeah, actually, that's fascinating. I'll have to think about that a little bit more, Martin, because there's it's one more thing though, isn't it? That comes back to this point is there's a lot of things that seem to be just that little bit lagged.
Yes.
I've got a chart up of these business insolvency by month, and so this is just by number. So look, on the right hand side is the construction chart, and so August was actually a record. Well, I think a record for the period which we've got the sort of more detailed data. So that was the last roughly 10 years. That's a black line there where you can see the number of insolvencies. Yep. It has started to fall back to, and insolvencies are very seasonal as well. So you get some very low numbers in January and December. And so that's why I've sort of shown this chart as, you know, a whole bunch of individual lines for years. And then because the actual charts, when you look at it, are actually quite hard to read what's going on. But the construction one, after, you know, posting some record numbers in August and September, has actually fallen back in October so far. Now, I don't know whether that's a sign that all of a sudden everything's better. I suspect it's more of just some number weighing, and you do sometimes find that because it's all by number, you know, one person with, you know, 30 different companies, but they're all really small, might fall over and that's treated as 30. And then one really large company falls over and that's treated as 1. And so, I don't think you can completely take these numbers to heart. But yeah, there's certainly what you're saying there about construction. It seems really high. Whereas on the left-hand side is the total number. And so the bottom two lines is 20 and 21. So we're well above that, but we're still at the bottom end of the recent range of that sort of, you know, the 5 or 10 years before that. So, there's still, you know, even though, as I said, they're so much higher than what they were for the prior 2 years, they're still not that high relative to the rest of it. And so the great question, which I think every insolvency person I speak to gives me a different answer, is there going to be a catch-up or not? And, you know, I think it's relatively evenly split between people who say, yeah, there's going to be a catch-up. There's all these companies that should have gone broke, didn't, but will go broke, versus the ones who go, well, maybe there was just enough money thrown at them and they all got enough, government handouts that there's a few of them that just quietly closed down themselves without bothering to go bankrupt, or there wasn't actually a tax office there to bring actions against them. So when they closed down, you know, owing tens of thousands of dollars to people, none of the people they owed the money to could bother taking them to court, and so it was just a business closure.
Yeah, I think one of the interesting things, again, from this conversation I had the other day, was that some of these businesses, what they're doing is they're morphing their business. So they're basically skinning it down, and what they're doing is essentially going over the Great Divide, go out west where there's all this massive flooding and the immediate reconstruction because people are actually getting paid big bucks to do simple, remediation work. So it's a very different mix of business than they were doing previously. And it means that they don't actually completely fall over, but it means that they morph their business dramatically. And I think there's quite a lot of that going on at the moment. So it's too soon to say, I think, how this all plays out. And, I don't want to over-emphasize insolvencies too much because it's just one indicator. But,
exactly.
But I would make the point that if it takes 2 years or so to foreclose on a mortgage, typically, right, once you start the process, so you would not expect to see high levels of foreclosure and high levels of mortgage, for sales at the moment. It's going to be a long way down the track. And
absolutely. And that's the same with the tax department ones, isn't it?
Yeah.
I mean, if somebody who'd been for 2 years not paying their tax bills and the ATO started chasing them on July 1 and there's a number of threatening letters and legal things and then the legal delays you can do and you're talking 6 months, probably at best to get to the bulk of them. You're more likely to be longer than that.
Absolutely. Well, why don't we move the conversation on a bit, because there were two theories going around markets, I think, the last couple of weeks. The first one was the Fed is not going to lift rates as fast or as high because there are signs that inflation is beginning to sort of come back a little, although actually the amount it comes back isn't particularly strong. But the second one was, and China's coming out of lockdown, and that means that China's going to be roaring back. Plus, of course, China's doing a load of stimulus. So that's going to actually drive the global economy.
Yes.
Now, that was probably appropriate a couple of weeks ago, but I have to say both those arguments look a bit sort of shaky at the moment.
Yeah, well, let's start with. We've spoken a fair bit about the Fed already, but let's move on to China because it's. I wrote something that sort of was basically China just changed everything, or maybe they've changed nothing. Like it's hard to tell because they came out with this 16-point plan for real estate companies, and it was so. And the market read that very positively. Like resources all boomed on that, and we actually removed most of our underweights. Just went, okay, the market's got a bit between its teeth on this. Let's not stand in the way of this one. Let's wait until reality starts to sink in, or let's see what's going on, because there's two ways of reading it. One is that China's had the whatever it takes moment, and they're basically going, okay, we've done 16 things, and they announced another 5 things this week. And they're just going to keep announcing things until they finally get back to where they were. That's one way of looking at it, and it might be the right way. And I think that's the way the markets are certainly looking at it. I suspect it's not the right way though. When you dig through the 16 announcements, it's 16 different ways to get debt back out to these companies, or to forgive debt, or to let them have debt for a little bit longer and let them not, let them extend the terms. There's nothing in there that's actually looking to try and create another housing boom in terms of the spending that they're doing. It's really is just a matter of how can we get more money out to these businesses that need to complete the properties. Then the announcements this week was actually just make it easier to put equity into these businesses as well. And so the thought that, okay, now you can actually these guys can start replacing their debt with more, making it easier for them to replace the debt with equity and things like that. Again, it's not something that to me screams that, they're out here trying to reignite some sort of housing boom again, and that, that we're going to see that we're going to see the huge jump in terms of the housing numbers, and going back to the old construction days where they're doing more than twice as much as what they're doing at the moment. Let me just see if I do have a chart here I was going to show, which is the got that one big enough for you? I think I have. Yeah, there we go. That's the one I was meant to show. So this is showing that China was on the left. This is a Chinese residential floor space starts, and it's a rolling annual chart. They're a bit weird in the way they present the data, but in terms of millions of square meters back, pre 2005 and around that period, China was urbanizing about 100 million people over 5 years, so about 20 million people a year, and their housing starts were sort of 400 or 500 million square meters. Then they went to urbanizing about 25 million, so not that much, 25 million a year, so not that much more, about 20 or 30% more, but they tripled the amount of building that they did. Then that fell back a little bit in 2015, and China started to go into reverse, and commodities all crashed, and everyone was worried that China was going back to the old days of not overbuilding apartments. And so they turned it back on again, and it boomed again. And now we're back to triple again the amount that was sort of needed. Then we had then they started to put on the 3 red lines. COVID hit. They turned it back up again. And now we're finally starting to see this actually fall back to more reasonable levels. Now it's still double what it was, the 2005 levels. When you look at the urbanization rates in China, China looks like it's going to urbanize less than 100 million people. So you could halve them again, halve the starts again, and you'd still only be back to the levels when they were last urbanizing this many people. And that sort of ignores the big overhang of empty apartments that's out there already, and the apartments that are being constructed but aren't finished yet. So one in every 6 households, or one in every 6 urban households, has a new apartment being built for them right now. Like, it still hasn't been finished, let alone the ones that are finished and completed and sitting empty. Like, you could easily come up with some pretty good arguments to say that these are going to be a lot lower. Now, none of the stuff I'm seeing out of China says we're going to try and get the property boom going again.
No.
We're going to try, and it's all about construction. We want more buildings and more of this. It's all about saying, how do we complete the existing ones, and how do we make sure that these existing developers don't go, don't end up going bankrupt, and don't sort of start bringing down the rest of the economy with them. So if it's true that this is a whatever it takes moment, and China's going to reverse this, and they're just going to keep throwing money at the problem until that blue line goes back up to where it was before, then buy commodities with your ears pinned back. We're in for another boom. If that's not true, if it's just they're trying to complete the ones they've got and they're trying not to bring the rest of the economy down, which is what I think seems more likely, then it's not a positive sign for commodities, and it's almost time to start selling them again.
Yeah, and just a couple of observations. Of course, the other thing they did was to reduce the RRR, in other words, the reserve ratio, right, which basically allows the banks to lend more. And they keep doing that. Of course, there are risks attached to that, because it means the banks have got less capital, right, in terms of buffers. But again, if you look at the quantum that creates, it's a sizable, but it's not earth-shattering. So it seems to me that a lot of the stuff that they're doing is about just keeping a few balls in the air, rather than fundamentally trying to give a huge momentum back to the whole market. So I agree with you. I don't think that this is actually a return to where they were previously, which means that if you're betting on high consumption of steel and other commodities because of it, I think that's probably a bit optimistic.
Absolutely.
Yep.
And I've sort of run a few times my thoughts on copper as well, in that copper is its biggest use is the Chinese housing market. And so when you look through all the uses you could possibly get, and there's a number of people who've been pushing stories. I'm apologize. I can't remember if I spoke about this last time, but there's a number of people out there pushing this story that there's going to be this huge copper shortage, and you need it for the grid, and you need it for solar and all that type of stuff. And the thing is, yeah, you do, but it's a small part relative to how big the Chinese housing market is. If the Chinese housing market isn't using all this copper, then we've got heaps of spare copper.
Yep.
And if we don't build as much, if the grid turns to smaller grids with local batteries and less sort of spread out right across the country, then we might need less copper again. And then there's some new mining techniques they're looking at that are sort of going through some of the old copper that might mean that there's a whole bunch of extra copper that's now available and at a lower price. And so there's a number of the commodities that people are most bullish on, and in terms of talk that I have some pretty serious concerns about.
Yeah, and I suppose the other thing China-wise is the lockdowns are still there, and the fact they've got a higher case numbers than previously, and they had those various protests over the weekend, which were quite widely reported. People standing up with blank sheets of paper, and that they've sort of started to try and cramp down on them now. But it does feel to me as though we're at a bit of an end stage game with regard to the lockdowns, and I suppose you could argue that Xi's got through the conference season, as it were, and got the endorsement. So will they or won't they, or will they continue for the fourth year to continue with their COVID zero strategy? Because that's the other factor. Again, the markets 2 weeks ago were very bullish on China reopening and the lockdowns effectively being a little bit more fluid and flexible.
Yep.
But you wonder now whether that's actually the right way to read it again.
Yeah, well, I mean, the Chinese people are with you there, aren't they? They're trying to get out of lockdown. Yep. Look here. There's so many different angles you can take on this one. I'll probably start with the one that says, well, look, China has got more control over what their people hear and see and have ability to access than any other country in the world. So, and I think they have a desire to keep the protests to a minimum. And so I think if any country can crack down on these protests, then it's probably China, more so than any other country in the world. Yep. So that's one front. The other one is they're actually not that well vaccinated. So there's a lot of the older people don't have it, and the vaccines aren't that good. And so, genuinely speaking, if they go to COVID, they ditch COVID zero and let it loose, you could be talking 5 or 10 million people that could be at risk. Now, China it's almost as if they've gone down a path at the start where they've said, okay, we're not going to use the Western vaccines, we're going to use our own vaccines. And once they've made that decision, now they genuinely have this health crisis of will they allow that many people to die, or will they just keep it quiet? They've spent 3 years explaining to their population how great China is, that it's protecting its people, and how bad the decadent West is for letting this run rampant, and how you need to be vigilant and you need to accept being locked down, and you need to accept that you're going to be tested multiple times. I heard a statistic, and I don't know where I don't know. It was on a podcast, so I don't know if it's true, but they're talking about it costing 1.5% of the GDP per annum to do the testing, which might be true. It's certainly in the realm of the amount of testing they've been doing. It's clearly very expensive to do that. So I guess where I'm coming to with it is it would be a very difficult decision to open up and just say let's let people die, and maybe they'd hide it and just push on. But it's not as simple as other places where we obviously in Australia we had our limit where everyone was the race to, if we can just get this many people vaccinated, then we can all start opening up and we can all start. You had to get your 2 shots, and then everyone was free. China doesn't even have the deadline there, because they're using vaccines that just aren't as effective, and so and they will have to then go, okay, we're going to use the ones from the West. I don't know what the way out is, and that's one potential though as well. I talk a lot about the China housing, and could I see a scenario where they want to get out of this, and so then they let people go, they let it go, they try and dampen down and sort of hide the number of deaths, and in the meantime they start this massive stimulus program to get housing going again, and all the things they used to do. Yeah, sure, I could see them doing that. I don't think it's the most likely scenario, but I think we need to be aware that we're down to a couple of people and maybe only one person making these decisions. We need to be prepared for whatever eventuality.
And Cookie asked, will commodity prices take off after China reopens? I mean, that in a way is encapsulating the big question, isn't it? Because scenario one is yes. Basically, they really turn the dial up, and that puts another upward momentum on commodity prices.
Yep.
But there's also another scenario that says no, they're not going to do sufficient. They'll continue to sort of hunker down, and actually commodity prices have sort of come off the boil quite significantly at the moment. So it's a really big question.
I mean, iron ore's been holding up quite well relative to other ones. I suspect it'll be I think the market seems to be, of the view that China reopening will reignite all these housing booms, and it might be right. As I said, I don't think it is. I think what we'll find is when China reopens, it will be positive for commodities in the first part. The question is, will it stay positive for commodities? And that's where I guess I'm looking at it saying, well, I don't want to stand in the way of the train at the moment. Is if China reopens and announces another 16 ways they're going to shove debt down everyone's throat to trying to get them to buy more property and make more property, then you don't want to be in front of that. But I wouldn't expect it to run 3 years or 5 years. I'll be talking 6 months before people start working out, hey, this is all those announcements about China reopening and all that, they're not actually reigniting the building boom, and the money's going into other things, other more productive assets rather than building houses just to leave them empty or to knock down existing ones just to put up new ones.
Yeah, well, it just shows you, I think, the precipice, and you can go one of two ways. I guess there's another precipice if we sort of change track, and that's to do with house prices locally. And it's interesting because Christopher Joy put up his chart today, which is up to the 28th of November, and basically he's saying, prices are falling. In fact, it's Brisbane and the Gold Coast where they're dropping the fastest at the moment. The others are falling, varying, but certainly more downside momentum. And interestingly, ANZ came out today with an updated forecast of a more significant downside fall. And SQM published their various scenarios, including one where property prices went higher next year, right?
Right. Well, how was that?
Their argument is that if interest rates don't go as high and perhaps come down again, that could be enough to start the momentum again. So that's where they go. But that's a bit sort of zigging where everybody else has zagged, because most of the other analysts are still talking about further house price falls over the next 1 to 2 years. And interestingly, ANZ said, look, the main reason why property prices are going to fall is not necessarily just because of the buy and sell point, but it's to do with the borrowing power point. Because of the fact that rates have gone up, you can borrow 30% less than you could previously. And that's the critical lever, which essentially is going to drive prices lower. And in fact, Cookie Boy threw 150 examples to me the other day of property prices falling in multiple states. I did a show yesterday with a jumbo edition, and there are some significant falls now. So it does look as though this momentum is continuing to grind lower. And of course, the question is how much lower, and what are the consequences?
Yeah, and just to tie it a little bit slightly back to China as well, I think China's similar to Australia in that there's a certain belief you have in property, is that if property prices, if that's a stable place and property prices don't fall and if they do fall, it's an opportunity to get in and buy and set yourself up. If you lose that sentiment, if that pushes too far, then I think there's another bit of a trapdoor beneath it. And so I guess what I tend to look at a lot of things as, how much upside is there, how much downside. And so you might look at a scenario like the SQM one and you say, okay, there's this scenario where, everything goes right and property prices can go higher, but I'm going to give that a low probability. And then you start looking through the probabilities of saying, what happens if things keep going the way they're going, and then you say, okay, well, that's a reasonable chance, and what those are, and then you look at when things start getting worse, and the getting worse. There seems to be like a lot more downside now than what I would have thought. 12 months ago, before the RBA, decided that it really wanted to ratchet rates as faster than it's ever done before. And at the same time as, these bankruptcies are just coming back on, and at the same time as, all these other factors we've been speaking about, all coming on a delayed basis. And my concern is that, that you could be sitting in the middle of next year with inflation starting to get back into the right range, and already though the house prices are falling away, you've lost your consumers no longer spending. Rate rises have caused all these people to be insolvent and companies to be insolvent, and that's still working its way through the system. The RBA is trying to backpedal, but actually it's going to take 12 months before its effects actually have anything on the market. You could see some scenarios pretty easily where you get quite significant downside, in the 10, 20 percent levels, without having to try too hard, and let alone if you ended up in situations where, for whatever reason, inflation stayed high and central banks decided that no, a recession's not enough, we need a depression to wipe out this burst of inflation. I don't think that's the case. I do think that. I do think once the central banks see the sort of the whites of the eyes, and we do get some rapidly falling unemployment rapidly rising unemployment, and you do start seeing rapid bankruptcy stats, I do think they'll reverse relatively quickly, but maybe they won't. Maybe they'll keep going. But I do think they're going to have to. They will keep pushing until they break something. And I do think they will keep pushing until we actually see some annualized inflation at more reasonable levels. And I think that annualized inflation is going to take a lot longer than you might think.
Yeah, and the interesting observation, because of course the ANZ and the others are talking at a very aggregate level, right? When in fact, as Ray says, are the biggest drops in the areas with the lowest stress as they try to get first. The truth is that ANZ and the others don't do granular analysis. It's a very much a top-down, think of a number, double it sort of story, right?
And use the poverty line.
Yeah. Exactly right. Now, the truth is that even now there are some properties that are selling significantly above where you might expect, and in fact there are some still hitting records, right? There are other areas where property prices are already sliding quite fast. Units are actually moving down a little less significantly than houses, because houses went up really fast over the previous couple of years. So all of those dynamics are sort of in there. So it's always, I think, worrying when you see these generic conversations about where property prices are going, and it really doesn't tell you a lot, which is why I always say you must go granular. But what I am seeing is more of the property that's on the market at the moment is not necessarily top rate property. It's sort of stuff that ex-investment property that people are selling, or it needs a lot of other work. And what that's tended to do is to drive the prices down lower than might otherwise be because of the type of property that are there. So what I'm trying to get to is
very compositional change.
Yes, that's exactly right. And I don't think that any of the numbers that are being produced at the moment really reflect the change in the characteristics of the properties that are currently being sold or not sold.
Yeah. Well, I mean, it's long been my bugbear, Martin. We've spoken a number of times about this, that I buy a house for, even in the hedonic where they make these adjustments, I buy a house for $600,000. I spend $300,000 adding all these things to it and stamp duties, and I sell it for $850, and the property price indexes say, what a great job you did. Bought it for $600, sold for $850, you're a winner. I'm sitting there going, just a minute, I'm out $150,000 on all my costs and all this type of stuff like that. So, and then, moving on to exactly your point that, if the composition changes, and you're in an area that has just built a whole bunch of swanky new apartments, and it's got a bunch of old apartments, and then all these new ones are selling for 50,000 more than the older ones, because it's a huge development. Then it makes it look like prices are booming, whereas maybe it's just a quality difference.
Well, it's interesting because I had a one-on-one conversation with somebody who's got 2 properties down in Melbourne. One was in a high-growth area where there were massive amounts of units. Bought about 4 or 5 years ago. Prices are lower than they were.
Right.
So there's no capital appreciation there. Also had a house slightly further out, doing quite a lot better. So it shows you, I think, the mix and location is really important, which is why I get very frustrated with these high-level, highfalutin numbers that really are quite meaningless. And quite often when I have these one-on-one conversations, I have to say, look, ignore these generic averages because they mask so much, right?
Yeah.
But it's hard sometimes not to get yourself fixated by what the industry is saying. Yeah,
absolutely. And that's, I mean, it's similar-ish on the stock market, in that there's definitely stocks that can you go through troubled times and they can go up while everything else is falling, but in the space I tend to play in the large caps, that's generally not the case. There's many fewer in the large cap space because they are the market, and when you're looking at stocks and you're trying to find ones that are going to buck the trend, you're probably talking about small caps, which are can pick up market share. They can go from a 3% market share to a 5% market share and things like that, and grow into whereas the large ones already have a 50% market share, already have a 40% market share, and it's very hard to change. The problem though is if you don't pick the right small caps, they're the ones that the valuation changes the most. Yep. So they go from trading on a 10% discount to the market to trading on a 30% discount to the market, and the market also falls 20 or 30%. And so, they're much more illiquid. And so, I think you can, with stocks, I find it's better to focus on the sectors that you're doing rather than trying to pick out individual stocks that are going to completely buck the trend. And if you don't like the outlook, then shift from stocks into bonds. Like there's it's very hard to find a market where big groups of stocks are going up while the indices as a whole are in a bear market.
Yeah, no, that's fair enough. Well, there are 2 final topics to cover tonight, and we've got 25 minutes left. The first one, I just want to touch on the crypto story a little bit because I think it's a really important highlighting conversation around, I think but you and I both have felt a certain amount of uncomfortableness with regard to where crypto was going to, right? And it's sort of the tide's gone out. Obviously, we've had FTX and BlockFi is now, which have affected a crypto lender, is also now in Chapter 11 as well. What's your take on all of this? And is it a significant thing that's going on, or do you think this is just a little bit of a sort of a sideshow, really?
Look, I think it's quite potentially significant. Yeah, it's sort of just to be slightly facetious, but it's what they need is some good regulation there, isn't it, Martin?
Any regulation?
And there's people already who are talking about saying, well, why weren't you regulating and fixing these and making sure this stuff doesn't happen? And it's like, well, that's what you guys told us what you didn't want. I mean, that was the interesting one with this FTX. They've, I think, the most senior guy there donated $40+ million to the Democratic Party, and his 2IC had donated $20+ million to the Republican Party. So they were donating quite heavily to both sides, telling everyone we don't need to be regulated. And what a surprise that unregulated industries end up having frauds within them.
And interestingly, the SEC were investigating them in the US a few months ago, right? So there was some sense of things weren't quite right, but it rather gets the feeling they didn't really take it that seriously. And as you say, they were flashing money around and were seen to be in the in crowd. Everybody wanted to be seen
naming sports grounds after themselves, sponsoring all these different things.
One of the things I wanted to highlight is this concept of multi-level marketing, where effectively the small number get in on the ground floor and then they basically make a mozza and they pull more people in who then make less, and pull more people in who make less still.
Yep.
That is what is at the heart of this particular structure and the particular entities. And it is about psychology, and it is essentially about hoping to make a quick buck and hoping that you can find a greater fall.
Absolutely, and some of it as well is this idea that you don't need the regulation. Without regulation, you can do all these extra things, and so when you talk about other markets, what happens is you get separation of a lot of things where it's like, okay, you're doing this part of it, you're not allowed to do this other part of it. So if you're if you're a broker, for example, you're not allowed to be out there trading against your own clients and selling them products that you've mispriced yourself or selling them the bonds and everything you've mispriced yourself. You need to be doing these on listed exchanges and things like that. And so the problem with a lot of the crypto ones is they were acting both sides. They're both I had a group come and talk to me about it, and they're explaining about how they make money both buying and selling particular instruments, and I'm like, how do you do that? How do you make money on both ends of the deals? And basically, it was because retail consumers don't understand it and they can't price it, and so we can rip them off on one direction and we can rip them off on the other as well.
Which, by the way, I just a bit facetious, but that is precisely what investment bankers were doing in 2008.
Yeah, well, yeah, but you're right. You're right in that in terms of those ones. I think they'd probably say that there was the ones I'm talking about, though. Investment bankers generally rip people off in terms of they package everything up and then they sell it and stick a margin on it, or they'd say, "Oh, this is fee free," and they just rip you off on the cost of the options. Whereas it looked as if these guys were doing that, and then when they're ripping them off to sell them the product. And then when the guys needed to get out of it, they were then ripping them off, back in the other direction, and taking something to sell it on to the next person as well. But and the other thing though is that a lot of these are paying these quite high interest rates. Some of them talk about 4 to 6% interest rates. Other ones talk about plus 10% interest rates. And the first question you go is, how the hell can they? Like, Bitcoin doesn't pay an interest rate. Like, it's not like there's a natural, interest. It's not like money where you have interest paid and you're lending it out and people are borrowing money in it and all that type of stuff. It's not, and you're not seeing people out there loaning massive amounts of Bitcoin that sort of would justify the paying of interest rates. And the reason why is because most of it's derivatives based. Like, they're basically what they're doing is they're using your capital as collateral to then go and trade derivatives off the back of it. And there's a hell of a lot of risk. And for people to go, "Oh, yeah, I'm getting a 10% interest rate on my Bitcoin," is like, what are you doing to get that? Bitcoin has a 0% interest rate on it. Like, it shouldn't be paying you anything. The only reason they're paying you that is because they're taking it and they're doing really, really risky things with it. And so, because the thing is, if they're paying you 10%, they're not doing it out of the goodness of the heart. They're probably making 20 or 30, and and paying you a small amount for it. So yeah, I think there's if it seems too good to be true, it usually is. And if you don't understand what it's doing, then you might be better off finding an investment where you do understand what it's doing. Like, that's
and what I like about it is that a lot of people who are into this claim that there's a mystique about it that you don't understand because you're too old, or you're too traditional, or blah blah blah, right? Actually, what it really means is that if you've got a nose for risk and you actually have seen this sort of stuff before, and I probably both have, you're a bit more skeptical about this magic pudding that's suddenly been created to produce an amazing return, as you say, too good to be true. And interestingly, if you go to BlockFi basically is a crypto lender, right? And they actually were bailed out by FTX.
By FTX,
right?
Yeah.
And the quid pro quo was that they would actually put a lot of their stuff back through FTX, and now it's gone, which is why they've had to fold as well.
Yeah, well, and the other thing is, and that comes back to counterparty risk as well. Yep. So you have this problem in a lot of this is that this is exactly why we have exchanges. So we've got exchanges because when I buy and sell, when I've shorted a stock and then I've taken a call option out or whatever it is. I've sold a put and I've done various things. So I've hedged my position so that I don't have these unlimited losses that could potentially take me under. That I'm relying on the fact that there's an exchange out there so that when the worst happens and this thing I've shorted actually goes up in value and I want to call on my hedge so that I don't set myself broke. I can trust that they've been collecting the margin and I can actually do that. Now, in a lot of cases, the same exchange that sold you that was also providing that other service to you. And so they've got, this huge conflict of interest. And also, and so that when one leg of my bet goes wrong and I look for my insurance, well, the insurance has been taken down by that same company that took down the first leg of my bet. And so, that's the danger from here is that you just see a string of these just sort of fall over one by one. Similar to what we saw with Lehman Brothers, and that was in a regulated industry, and there's a pretty good argument for this whole thing is that what we're seeing with Bitcoin is you're learning why we have regulations and why we created central banks, and you're just going through we've created this new form of money. And you're like, this is fantastic. And, look what we can do with it. And you're like, great, guys. Now you need all these other things because we've created new forms of money, multiple times over the last 100 years. And we've learned what we need to do and how we need to keep it safe. And so.
And what's interesting is that, if you start from the original philosophy of Bitcoin, which was decentralized, devolved, no centralized control, no single point of failure, right?
Yes.
What we're now talking about in this instance of crypto is the reverse of that. So effectively, the same sorts of philosophies that had been used for decades in investment banking, derivatives, cross-leverage, all of those things, completely rolled into crypto land and effectively have used precisely the old game plan in a crypto context. That's
because we say what's the best way to make money from people is sell them gambling products, and so and if I can price them at levels that people don't understand, then
and so then there might be an argument for saying, well, Bitcoin might be a bit different, but the point is the instance of crypto that we're seeing here and the cross leverage and the contamination of these sorts of leverage-led, derivatives-led strategies shows you that the risk is, you can't quantify the risk. You don't know where the risk is. You don't know who the counterparty risk is. You don't know how much it's worth. Might be worth zero. And that's a really important object lesson more broadly, isn't it? For particularly if you're going to think about a core investment portfolio, right? Which of course is what Nucleus Wealth is all about. What you want to make quite sure is that your core investment is not going to be subject to these same sorts of vagaries and risks and all of those things, right? There's a different philosophy that you need.
And when you want to sell it, you can actually sell it. Yep. Like this is the idea is that if you've got assets like your large blue chip stocks, you've got your government bonds, cash, these the liquid parts of it. When things go wrong and you really need that money, you can get it. Whereas you don't want to be in the assets where sometimes the small cap ones, there can be a 10, 20% spreads between. And what I mean by that is there's one person buying it, at $1 and somebody doesn't want to sell it $1.20 or other way around, selling it. And so you get this spread of like this massive amount where you have to take a 20% loss if you want to sell at that lower price or whatever. And then you get the ones which just lock up. So we saw a whole bunch of the unlisted trusts during the financial crisis to say, sorry, I know you gave me 50 grand or 100 grand and I'm a property trust and you were living off the dividends, but guess what? You're not getting any more dividends. We're winding this whole thing up and hopefully you have your money back in sometime the next year, maybe two.
Yeah.
And so, that you just want to make sure that when you're putting your portfolios together, you've got this, as you said, the word nucleus is the idea that there's this core safe part around it. Sure, you can put those other ones around it, but they're a smaller part of your wealth, and they're a diversified part. And they're part where if you do get locked up for a couple of years, it's not going to be the difference. It's not going to make a major difference to you.
And one of the things that I'm seeing in some of my conversations with people is that they were getting frustrated with the lower level returns from sort of more normal investments, partly because of where the interest rate cycle was. They looked over in crypto land and were seeing these massive returns and said, well, I need that bigger return, so therefore I'm going to go over there. And now, of course, they suddenly found that what they had is worth zero today. And that's the problem. And I know it's hard sometimes not to want to try and find the extra 4, 5, 6, 10%. But the risk is huge if you actually get into stuff that you're not really fully across and you don't actually really understand the risks that you're actually getting. And there's the old adage, isn't there? High risks equals high returns, or vice versa. If you get a big return, there's probably a high risk there somewhere.
Yeah, and the big danger comes from for me is when you're not understanding the risks that are behind the return. So there's some property funds that are quite sort of famous for marketing these products and calling them things like deposit products or very close. The word's very close if they've been caught and they can't call them those. And they're really quite high risk loans to sort of mezzanine finance or even these this type of lending that professional investors would want 25% returns on, and they're out there flogging to retailers and investors and talking about how you can get this great high yield 10% return on it. And an institutional investor would look at that 10% return and go, that's crazy. Yeah, sure, it's high, but seems high, but this thing is so risky. I want a 25% return to take that risk. And then there's other products within the property sector that might actually be low enough risk that you'd be happy to get a 7% return on it because you're sitting behind various levels and you've got enough stability and things like that. And you actually say, yeah, sure, I'll take a 7% return and be happy with that. So it's really about measuring that risk versus return. And that's where, as you said, it's the part where it might sound great. You're getting a 8% return on your crypto, but if the guy who's doing it is leveraging it up and using it as collateral and making a 30 or 40% return on it, then he's taking risks that he shouldn't be doing, and you should be getting, you shouldn't be getting 8% and he's getting 30 or 40. It should be the other way around. So, yeah.
And just another example, which is sort of more mainstream, the convertible bonds that some of the banks are issuing, right?
Yes.
Which again are paying quite a high return, but the risk is the conversion, right?
All the, as I like to say, all the upside of debt, which is nothing, and all the downside of equity, which is everything.
Exactly. Yeah.
So I think it's an important point, and there's two different instruments I'd like to sort of highlight on this front. One is bonds. The word bond can mean a government bond, that it's like the Australian government, and pretty much if you're looking at Australian dollars, it's as safe as an asset as you can get. And there's high yield bonds in companies that are quite likely going to go broke, charging massive amounts. They're both called bonds. They're very, very, very different investments, and they react very differently in different markets. And the other one is exchange traded funds. There are some great exchange traded funds out there which are very low fee and give you a broad spread of, I think some of the Vanguard and ones like that in the US are sort of 8 or 9 basis points. So 0.09%. They charge you per annum and very diversified and all that type of stuff. And at the other end, there's these triple leveraged, using derivatives behind it and all these other things that is called ETFs as well. And so, and some of them, are fine within your product if it's a small part of your investment, but it's a matter about understanding that just because it's an exchange traded fund doesn't mean it'll be good and cheap, and just because it's called a bond doesn't mean it's going to be safe and secure. There's very much extremes of both.
I think the other point to make is, Damien, that there's an accumulation phase, when people want to build wealth, but there's also a phase when you want to make sure that the wealth that you've built is secure. Right. And I think sometimes people don't understand the difference between those two. Yeah,
that's right. And look, part of it is what you find, when for anyone who's managed money, I'm sure will tell you the same thing, is that the people who have a lot of money and are seriously wealthy tend to make it from their own businesses or from investments in other businesses, and they use the investments in the stock market to say, I don't want to lose this money and I want to make a reasonable return on it. It's not about saying, I've come to you with whatever, $10, $20, $30,000 and make me a millionaire. Roll the dice and I want to see. I want to see massive multiples of returns. It's about saying, how can I stay rich, and how can I take the wealth I've got and grow it at a reasonable rate, and not take undue risks, and risk the fact that I might lose a lot of it. And so, and that's the difference, I think, between the way a lot of different people look at it. It's fine to have a view that, okay, I'm going to try and find, the next Microsoft and the next Google, and I'm going to find these stocks and I'm going to double, triple, or be up 10 times my money. But that shouldn't be with 80 or 90% of your wealth. That should be a very small part that you're saying, yes, I'm going to have a gamble. I really like the idea of, whatever it is, whatever stock you've found and whatever you think is going to grow. But, having that core part of your money somewhere safe, somewhere that's liquid. If you need it, you can actually get it. And somewhere that's not going to see as much volatility as you're going to see elsewhere.
Yeah, and so the concept of diversification and making sure that you've got the right mix in the right places, which is what investment is, not trading, investing is all about. Well, we've got 5 minutes left, Damien. So your reflections then on the year today, and your thoughts in terms of going into the new year. How are you thinking of the portfolio management at the moment?
Yeah, so now it's really coming down to timing. I think in terms of the bond trade, I think we've basically seen this year has been as bad of a bond market as you've seen. Depending on how you measure it, probably ever. But there's certainly it's in the top worst couple of years you've seen ever in terms of bond markets. There's and equity markets were down quite significantly. They've made a pretty good bounce back. But the question now is, where do we go from here? And so really from a big picture perspective, it's about saying the froth has come out of the market. So the central banks were, at the start of this year, they were still at the stage of pumping money into the market, and we had these sky high valuations. They took them out, they've then reversed. And we've seen all those sky-high valuations come back to more reasonable levels. Still expensive, but within a more reasonable range. We haven't seen earnings fall yet. We're expecting that to be the next shoe to drop, and that's what's really going to be driving this next year. Is do we see the bankruptcies come through? Do we see the interest rates really start to bite into consumer demand? And then from there, we start seeing earnings falling, and how far and how fast are they going to fall? If we start seeing signs that actually this is going to be pretty shallow, and the central banks are going to reverse, then we'll be reversing and jumping into equities at that point. I think all the noises they're making to date pretty much say they're going to crush this inflation, and they don't really care about the stock market. They don't really care about the housing markets and all that type of stuff. They're here to crush inflation. And for the moment, I believe them. I think once we get to the stage where we've got high unemployment and inflation crashing, I think they'll change the tune. But that's a while away yet, and that's we can make that decision when we get there. But for my 2 cents at the moment is I think they won't get there until it's too late anyway. I think given the way everything's delayed, by the time they've worked it out, it's going to be too late, and the recession will be baked in, and so we're taking from there. So for now, it's waiting and watching. I think the bonds are pretty close to as far as they're going to go in terms of bond yields, and so that from here on, there should be some decent returns in bonds, and then hopefully from there, it's as bond yields fall first, which means bond prices rise. And so you make a little bit of money out of that. You're not going to make huge amounts, but you'll make a little bit out of that, and it will keep your money safe. And then we'll be flipping into equities, at hopefully at lower levels, having seen earnings fall, and then starting to see some reversal and things like that. So yeah, that's the rough plan. But things will change. I guarantee it.
Things always
We'll
change.
be back here. We'll be back here in 5 weeks' time to talk about it, I'm sure.
Yeah, absolutely. Yeah. Well, Damon, thank you very much, and really appreciate your thoughts. Always a rich conversation. If people want to find out more about What the World Funds, which you run for me, using the Nucleus Wealth engine or indeed Nucleus Wealth, the links and things are below. And just to underscore again, as part of your core investment strategy, you need a firm foundation. That is precisely what Damien does. And, the markets will be up, markets will be down, portfolios will be up, portfolios will be down. But you've got that firm foundation, and that's the critical thing, isn't it?
Absolutely. Yep. Doesn't have to be us, but make sure somebody at least has got those blue chip assets at the center of it, and then do the exciting stuff around it. But make sure that center stuff is full of those safer assets.
Excellent. Well, thank you very much. I'm going to take you offline, and I'll close the show, and we'll have a good Christmas, good break, and we'll pick up in the new year when there'll be, I'm sure, more to talk about.
Thanks, Martin.
Thanks. See ya. So there you are. Thanks to Damien. And just to close the show, a couple of people asked about Harry Dent. There's no point having Harry Dent back on because it'll just say what he keeps saying. Until Harry says something new, there's no point. So that's why you won't see him on the show for at least the next little while, I think. Just in terms of next week, just tell you that I'll be on talking specifically about my latest household finances and the stress and scenarios. I've got a whole bunch of new data there, some new survey information too. So mark your diaries for next week. And the following week, I've got, I think, Cameron Murray coming on to talk about some of the work that he's done. I've got Tony Locantro coming on towards the end of the year. So we'll have his thoughts as well. So that's the plan for the next few weeks on the show. And just before I go, of course, we have to revisit the doggies, who have hardly moved. In fact, Luna did get up and sort of wander around, so she's messed up her bed once again, but that's okay. We can rebuild it. And I want to say thank you very much for spending some time with us this evening. Hope you found it useful and insightful. And check out the other shows during the week. We put several shows up a day at the moment, a lot going on. And look forward to seeing you on the live show next Tuesday. This is Martin North from Digital Finance Analytics, signing off. Good night.